Right now, the average American carries over $22,000 in personal debt. Most of us are taught to pay it down slowly, invest a little, and hope for the best. But 600 years ago, one Italian family looked at debt completely differently and quietly became wealthier than any human being alive on Earth today. Their secret was technically illegal, and it is hiding in plain sight inside your own bank account right now. The year is 1397. Florence, Italy. A city of 200,000 souls, more than London, more than Paris, crammed inside medieval walls perfumed with wool dye, horse sweat, and fresh bread. This is the most financially sophisticated city on the planet, and on the Via Porta Rossa, a man named Giovanni de' Medici has just opened a small currency exchange counter. Giovanni is not noble. He has no title, no army, no land inherited from crusading ancestors. What he has is a ledger, a single-bound book of accounts, and inside that ledger, he is quietly doing something the Catholic Church has explicitly forbidden under pain of eternal damnation. The Church's position was absolute. Charging interest on loans is usury. Usury is a mortal sin. Men have been excommunicated for it. Fortunes have been seized. And yet the economy of all of Christian Europe runs on credit. Merchants need capital to move wool from England to Florence. Kings need loans to fight wars. The Pope himself needs financing to build cathedrals. Somebody has to lend the money. Somebody has to collect the return. Giovanni de' Medici decided that somebody would be him. And over the next 30 years, the accounting trick he used to do it legally, or at least legally enough, would transform his modest currency table into the most powerful financial institution in the Western world, and make the Medici family conservatively worth the equivalent of $129 billion in today's money. That is more than Elon Musk's net worth at the time of this recording. And it started with one entry in a ledger. Here is the trick. And pay close attention, because this is where history stops being a school subject and starts being a masterclass in money. Principle 1. The cambium contract, or how to charge interest without calling it interest. The Church banned interest, but the Church had no problem with exchange rates. So the Medici invented a financial instrument called the cambium contract, or letter of exchange. Here is how it worked. A Florentine merchant walks into the Medici bank and needs 100 Florentine florins converted into English pounds to buy wool in London. The Medici give him the florins today. The merchant repays in English pounds 60 days later, in London, through the Medici's London branch. The key: the exchange rate built into that 60-day contract was always slightly favorable to the Medici. There was no stated interest rate. There was just a currency conversion. But the Medici set the rate. They controlled both ends of the transaction. The spread between what the merchant received and what he repaid was pure disguised interest, running between 8 and 14% annually. This was not charity. This was financial engineering 6 centuries before Wall Street invented the term. Principle 2. The branch network, or geographic diversification before index funds existed. By 1420, Giovanni's son Cosimo de' Medici had expanded the family bank to 8 branch offices: Florence, Rome, Venice, Geneva, Bruges, London, Avignon, and Milan. Each branch was legally a separate partnership. Cosimo owned a majority stake in each, but was not technically the owner of any single one. If the London branch failed, it could not bring down Rome. If Venice faced a banking crisis, Geneva was insulated. This is a holding company structure. This is exactly what Warren Buffett uses at Berkshire Hathaway. The Medici invented it in the 1420s. Their branch diversification meant that between 1397 and 1494, nearly 100 years, the Medici Bank never experienced a total collapse. Individual branches failed. The system survived. In real numbers, Cosimo de' Medici's personal share of bank profits between 1435 and 1450 averaged approximately 6,500 large florins per year, equivalent to roughly 15 million modern US dollars annually from banking alone, not counting textile revenues, property, or political influence. Principle 3. The discreto system, or paying depositors without calling it paying depositors. Here is perhaps the most elegant trick. The church also had opinions about paying interest to depositors. It complicated the usury question from the other direction. So the Medici formalized a system called the discrezionale, or discretionary payment. Wealthy clients deposited gold with the Medici. In return, they received no stated interest. Instead, at the end of each year, the Medici made a discretionary gift, a gift of gratitude, recorded separately in the ledger, never contractually obligated. That gift ran between 5 and 8% of the deposited amount, every single year, for decades. It was interest. Everyone knew it was interest. No one called it interest. The church looked the other way because the Pope's own finances were managed through this exact system by the Medici Rome branch. This is how an institution becomes too big to prosecute. Sound familiar? Principle 4. The ledger separation, or double-entry bookkeeping as a shield. The Medici were early adopters of double-entry bookkeeping, the same system every accountant uses today. But they used it for something beyond accuracy. By keeping 2 separate ledger books, one recording gross transactions, one recording net positions, they could present regulators or church investigators with whichever book told the most convenient story. It was not fraud in the modern sense. It was strategic transparency. They showed you exactly what they wanted you to see. The rest was legal architecture. 4 principles: letters of exchange, branch diversification, discretionary returns, ledger strategy, one family, 100 years of uninterrupted dominance over European finance. Now here is why none of this is just interesting history. Every single one of those Medici principles has a direct equivalent in your financial life right now, and most Americans are ignoring at least 3 of them. Modern. Move 1. Use the spread, not the rate. The Medici did not fight the interest system. They worked inside it, reframing every transaction so that profit came from structure, not from a stated fee. The modern equivalent is understanding the difference between the interest rate on your debt and the real rate of return on your investments. The average S&P 500 index fund has returned approximately 10.7% annually over the last 30 years. If you are carrying credit card debt at 24% APR and making minimum payments while putting nothing into the market, you are on the wrong side of the spread. This week, log into your accounts and calculate your personal spread. What are you earning versus what are you paying? That gap is your #1 financial enemy right now. Modern move 2. Build your branch network. Cosimo de' Medici did not put everything in Florence. He could not afford to. Neither can you. A single income stream, a single employer, a single asset class is the financial equivalent of having one branch in one city. The modern branch network looks like this. Your 401k contributions in low-cost index funds, a Roth IRA if you qualify, a high-yield savings account for your emergency fund currently earning 4 to 5%, and if your income allows, a taxable brokerage account for broader market exposure. 4 accounts, 4 branches. A crisis in one does not destroy the system. This week, if you do not have a Roth IRA open one. Contribution limit for 2024 is $7,000 if you are under 50. Modern move 3. Understand what the discreto really means. The Medici's discretionary payment system was built on one insight. The people with the most capital get the most access to returns, and the terms are never fully disclosed to outsiders. This is still true. Your bank's savings account pays you 0.4%, while they lend your money out at 8%. The spread is theirs. A high-yield savings account at an online bank pays you 4 to 5% on the same FDIC-insured deposit. Same money. Different institution. Different deal. Moving your emergency fund, even 3 months of expenses, from a traditional savings account to a high-yield account is the modern discreto. This week, search for HISA rates, move your cash, and collect the gift. Modern Move 4. Understand your ledger. The Medici knew exactly where every florin was at every moment. Most Americans do not know their net worth to within $10,000. This week, write down 4 numbers: total assets, total debts, monthly income, and monthly expenses. That is your ledger. You cannot manage what you cannot see. Free tools like personal capital or a simple spreadsheet will do. The Medici ran an empire on handwritten books. You have no excuse. 4 moves. You can begin all 4 before Friday. 600 years ago, a man with a currency table and a forbidden accounting trick built a dynasty that still shapes the art, architecture, and financial systems of the Western world. The Medici did not have Robin Hood. They did not have a 401k match or a HISA. They had structure, discipline, and a willingness to see money differently than everyone around them. That is available to you right now. Before you go, I want to know, which ancient civilization should we cover next? Drop your answer in the comments. Should it be the Babylonians, who invented the first written loan contract in 2000 BC? The Roman Empire, whose inflation crisis mirrors what the Federal Reserve is dealing with today? Or the Dutch East India Company, which created the world's first stock market and first short sale in 1602? Comment your vote below. Every answer influences our next video. And if you want to know how a Venetian merchant in 1300 used a technique that maps almost perfectly onto modern dollar cost averaging into index funds, that video goes live next Tuesday. Subscribe and hit the bell so you do not miss it. Wealth of Ages. History is the best financial advisor you have never hired.